we do have great content planned for you in this segment where Tyler has found a couple of trading ideas. And what we're going to do here, Matt, is we're going to let coaches geek out. In fact, I remember talking to you a couple of weeks ago about this idea, and you're like, you know what? I normally don't like it when the coaches go all full option risk graph with beginners and all that kind of stuff. But this is the one time in the week, Tyler, you can go full nerd, full options nerd on me if you want to.
Full options nerd.
Absolutely. Whatever you'd like to do. So, Tyler, what you got first?
All right. Well, you kind of spilled the beans on this one. I'm going to use Exxon. I like what crude oil is doing today. I really like what crude oil is doing today, actually. And energy sector firming up nicely. To Matt's point, Exxon is closer to breaking out than XLE. So I want to do a trade on Exxon. I think energy's had long enough to firm up here. The 50-day moving average is caught up. If you like the space, today's movement, I think, gives you an excuse to or a reason to look at it. I think I got an easy, clean technical trigger here over 58 bucks. And I think we can come up with some pretty compelling option strategies. So if I understand the game correctly, I'm giving you two ideas, two option strategies. Are you guys picking which one you like best? Is that the idea?
Well,
yeah.
We're going to figure out the game over the next few weeks, I'm assuming. But what I would say is you have two picks, both advanced option strategies, and we're going to either say yes or no and then pick our favorite.
Okay.
Sounds good.
We'll start with that, and then I'm certain we'll figure out a way to judge you personally over time.
I welcome that.
Yep.
All right. Options are cheap. IV rank is at 1.9%. Remember, 0% on IV rank means implied volatility is the lowest it's been all year long, right? So we're like bottom of the barrel in terms of option prices. That makes it hard for me to be excited about selling a put or a bull put. So I'm going to be doing a couple of call spreads. And when I think about call spreads, ultimately it comes down to how aggressive I want to be. So given our number spectrum, 1 being mildly bullish, 2 moderately bullish, 3 aggressively bullish, I'm going to give you a +1 trade, moderately bullish, and then I'll compare that to like a 2 to 3 trade, right? So my personal preference is I tend to favor the +1 trades, the mildly bullish, because they have a higher probability of profit. The strategy that fits with that and a low IV environment is a poor boys covered call, or you could refer to it as a bull call diagonal spread. So the idea here is I think Exxon breaks out, makes its way higher. I want to build a trade that profits if this hangs out at 57, 58, 59, 60, anywhere in that vicinity. I'm going to build a trade that gives me a nice little return. The structure of a bull call diagonal, I'm going to buy a 2 or 3 month in the money call option. Then I'm going to sell a 1 month out of the money call option against it. So I'm going to go to the trade tab. I got June, July, and May. If you want to make the trade cheaper, you buy June. If you want to make it a little more expensive, maybe have the ability to sell 2 months against the option you bought, you could buy July. The ROI is always a little sexier when you buy 2 months and sell 1 month. So that's what I'm going to do in this case.
Can I ask you a question on the time frame here?
Mm-hmm.
What are the things you're going to personally look at when you decide on this type of strategy where you're going to buy a little bit more time, sell against that short term?
Mm-hmm.
How do you make the decision between 65 and 93 days?
You know what I found over time is I feel like you start with good intentions. You're like, I know Exxon. I've known Exxon for years. He's a good little boy. He's going to behave for 3 or 4 or 5 months, and I'll be able to sell 3 or 4 or 5 months worth of cover calls. Yeah. So you're like, all right, so I'll buy a 6 month option with the intent that I'm going to be able to sell 1, 2, 3, 4, 5 months against it. And then you get 1 month in, Matt, you paid all that money for that 6 month option. You get 1 month in and Exxon goes to pot, it breaks support or something and you get out of the trade. So it's like,
OPEC
I paid all this money for this time I didn't end up needing.
So over time, do you feel like you have a tendency to buy a little bit less time because that gives you a little bit more flexibility?
Yes, you can adapt month to month. I feel like there are trade-offs, obviously, there's drawbacks, but I feel like that's where I lie.
Okay, so when in doubt, you would prefer the 65, unless you see something in the 93-day contract where you're like, I like this one. It's just a better priced option, whatever it is. You typically will say, give me something around 2 months in a strategy like this.
Yeah, because I feel like what's the worst case scenario? It works that first month, and I'm like, you know what? I should have bought July already, because I can build the trade again, right? May expiration, I can be like, all right, that worked. Let's close this trade, sell June, buy back May, I'm done. I'll set it up again, buy July, sell June. And I can just redeploy it that month with another 2 month, 1 month type of spread.
Mm-hmm. Yeah. I might have other questions, but for right now, I'm good, Ty.
So I'm going to go to June. And if this is like a poor boy's covered call, I'm trying to buy a call option that behaves like the stock. It's a proxy for the stock. The whole idea is to make the trade cheaper, because a normal covered call, you'd have to buy 100 shares of stock. So I want a call option that's going to kind of walk like a stock, talk like a stock, but not be near as expensive. And so I need a little bit higher delta on the call option. Honestly, anything around 65, 70 is actually high enough. I don't think I need to go buy a 95 delta and fork out a ton of money. So I think I might just start. And I usually, more than any spread, I think the diagonal, you got to massage a little bit. Like you pick what you think is going to be a good strike, then you look at the risk graph and see what you think. And you can massage it a little bit at that point if you need to. So let's start with buying the June 52.50 call. Right. So again, that's kind of my stock substitute. And then I'm going to sell a cover call against it. I don't think I need to be overly clever on which month or expiration I pick. I like to stick with the monthlies because they're the most liquid. So I'm going to go to the May and basically sell the cover call that you would sell if you were doing a traditional, or sell the strike that you would do if you were doing a traditional cover call. 48 delta is too high for me, so I'm selling a 30 delta call. So getting about $1. That's the one I'm going to sell against my June. And that makes the whole trade about $4.50, which is honestly less than cost of 10 shares. So that's pretty cheap. If I analyze it, this is what the risk graph looks like. And if you've structured it well, it should look pretty similar to a cover call. And that looks pretty darn similar to a cover call, except it didn't cost me $5,700. It cost me $450.
And Tyler, can you specifically talk about, just for the community, about what's going to happen over the next 30 days to the difference in the theta? Because when you go to the risk graph very quickly, not the risk graph, but when you go to the option chain, you have a very similar theta decay on your 65-day option as you do on your 30-day option right now. Versus if you were to buy the 90-day option, you would be capturing more theta right now. And so you'd be capturing 1 theta versus where those options are right now. You're not really capturing any theta yet. But what happens over the next 30 days on that front month option in comparison to the 60-day theta decay?
Yeah, so 2 ways you can explain that. I mean, first of all, the front month option is going to decay in value faster. And so when you look at the Greeks at the beginning of the trade, like this is the spread risk characteristics.
Yeah.
Your theta is 1, right? So the initial time decay is pretty minimal. But as time passes and that June option gets closer and closer to expiration, it's worth $100 right now. It's worth $1, that short-term call option. That's all time value. That's all extrinsic value. That's going to lose $100 of extrinsic value between now and expiration. And that is more than what the June is going to lose. That there's not $100 of time value that's going to be lost in the next 37 days. So as your short-term option loses value quicker than your long-term option, that's a net positive to you, and that will be one of the forces driving your profit.
Well, and when you look at the June option right now, you're decaying at about 2% a day. Right now is what you're decaying on that June option. When you look at that would be the May option. The option you're selling is decaying right now at about 2%. By the time that expires, that decay rate is at 100%. And so it's about 30 days out, that option is going to decay at about 1.5 to 2% a day, depending on volatility. When you look at the option decay the last week of the option, the net decay is starting at like 16% per day. And then at the last day of the option contract, the decay is 100%. Well, when you're looking at that 65-day option, the one you're looking at buying here, and I believe you were buying the 52.5, right?
Yes.
Well, that right now is decaying at literally like 0.008%. And that will end its decay in 30 days at 2%. And so the entire philosophical viewpoint on the decay is what you're doing is you're trying to take advantage of the option that's going to start at a decaying rate at 2% and try to capture that as it decays at 100%, versus the June option that's only going to start decaying at about 1% and end its decay in 30 days at about 2%. This trade, what you're really trying to take advantage of is simply that understanding of time decay between 30 days and 0 days and 60 days and 30 days.
Yeah, correct. And the impact of time decay versus other variables kind of depends on which strikes you pick.
Yeah.
And so when you layer in, okay, what about if the stock goes up or down? That's going to play another part. And so whether or not the majority of the profit comes because of time decay or the majority of the profit comes because the stock price goes up, yeah, it's going to depend on what does the stock do. But obviously, and you can kind of gauge that. You can say, well, we're at $57.50 right now. If we don't move, what is my profit at expiration? It's the blue number on the bottom left there, $55, right? Yeah. But if I can get Exxon to break out and be mildly bullish, remember, this isn't a zero trade, a neutral trade. This is a +1 trade. And so if I can get Exxon to break out and move up towards $60, you know, I have a potential profit of upwards of $290, which is more than a 50% return. Right?
In a month, and anybody in the world would take that.
Oh, yeah.
I love this trade. It's a conservative trade on a conservative stock that is coupled with a breakout potential on Exxon Mobile and energy confirming that support pivot. I love the trade because you have a slight bullish bias on the stock, and you're meeting a slight bullish option strategy to meet that technical condition. I personally love it. It's a great way to bring in a little bit of cash flow on Exxon while simultaneously taking a directional posture on it.
Couple of quick questions I have about the trade. I really like the concept here too, especially where the IV ranking is. You have a positive Vega on the trade as well as all the theta consideration.
Positive Vega, positive theta, positive delta.
Yeah.
Those ones aren't easy to do when you can get positive delta, theta, and Vega all working for you.
How much do we lose if it goes below 54? That one quick question on risk. $150?
Yeah,
depending on how much time
you manage it and what's going on.
It'll be a little more if it takes a couple weeks to get there, but yeah.
Okay. All right. Okay. And then part of this whole thing is you're going to find a trade idea, which Exxon obviously got the technical pattern, but we were going to look at two different option plays. So what's the second one you had on Exxon?
So to compare this, just keep in your mind's eye what the profit range was. My expiration break even is 56.75. As long as Exxon is above 56.75, which it already is, by the way, so it can go dead sideways or down a little bit and I still win. You know, I get a profit, and the max profit is, what do we say, 291 on 459. So your max profit's about 63%, right? So if I'm now going to look at an alternate strategy, it's either going to have a different profit range. You know, I need the stock to go up even further. And quite frankly, if I'm going to shift this and make it a +2, +3 trade and require the stock to go up more to make money, they better pay me more than a 63% return. Otherwise, I should do this trade, not the other one. So what you're going to discover on this second idea is I'm going to make it a little bit more aggressive, which requires the stock to move more, but in turn, they're going to give me a better ROI if I'm right, right? So all I would do different here is I would just do a bull call vertical spread. Bull call vertical spread by buying and selling options in the same month. So instead of doing different months, I'm going to do the same month. When you do a bull call vertical spread, if you go far out in time, it takes it a while to play out. And so it's really conservative. If you do like super short term, it's really aggressive because you make your money fast or you lose your money fast. And so I'm going to go to June. I don't want to do May. I want to do June. I think it's a little more conservative. So I'm going to use June options for this. And I'm going to purchase, now this is where personal preference comes in. What I'm going to do, it's around 57.50 right now. So I'm just going to buy an at the money option, 57.50 strike. And I'm going to sell a 62.50 against it. So I'm buying an at the money call and I'm selling an out of the money call against it to reduce the cost. That's going to give me a $5 wide spread, and I'm paying about $1.54.
Mm-hmm.
And so if I look at the risk graph of this one, and this I think is where it gets fun when you have risk graphs and you can compare contrast here. If I just look at this new trade, first of all, it's a cheaper trade. Verticals are cheaper than diagonals because you're buying and selling in the same month. So it's a cheaper trade. But because of the strike prices that I picked, look at my break even. We now have to get up to $59. Exxon has to rise. This is not a zero trade, not a +1, more of a +2 trade. Got to get above $59, which quite frankly, when I look at the chart, I think is totally doable. $59 is not asking much. It's less than an ATR away. And it's got 2 months to get there. But my max upside, if it gets above 62.50, is $346. It's not only 100. That's not 100% return. It's more than a 200% return. And all we got to do is get to 62.50, which is not crazy. If you go look at a chart, all you're doing is requiring this to get above the prior pivot high. If it can work its way up there, I've got a trade here where I'm risking 1 to make 2, risking $1.50 to make 300+ bucks.
So it really comes down just to the aggression, obviously. I mean, option traders know that they've got different tools in that tool bag. And, the pun about options is you do have options, right? You have all kinds of different ways you can play them. I'm looking at the conditions here. And obviously, I like the upside of Exxon Mobile as well, if you can catch the breakout. But for me, go back to the trade tab. There's a couple things that stand out to me. The cost is really dirt cheap for a bull call spread. On a $5 window, there's kind of a standard I was taught 15 years ago, Tyler, which is 40% of the spread when you're building them similar to this. So you're lower than that right here. You're paying only about 35% of the spread, something like that, something a little bit lower than that. So you're getting reasonably good cost in the debit spread. Click on that risk graph for a second. You'll notice one very, very just simple mathematical switch though. Bull call has a negative theta because of that need for it to get above the break even that Tyler's talking about at $59. Yeah, if it doesn't move, if you don't catch the breakout, it will just fade and kind of drift with the time decay over time. I can see both as very, very good. Part of where my head is, though, I love the volatility consideration here. We're 2 weeks in front of earnings. I do think Vega is going to pick up. Having the positive theta on the diagonal in what I think is a really nice little stable range that stock's been in for a few weeks. It leads me towards, choosing that diagonal. But before we make that choice, Matt, what do you think of the vertical here?
I think they're both awesome ways to play Exxon Mobil on this potential trade. I think it comes down to how you see how aggressive you see Exxon above the breakout channel and whether or not you want to wait for it to break out. If you're going to wait for confirmation, I like the bull call side of it. I do. It's cheap. You're not paying a lot. You got cheap risk here. But I do like volatility working for you. And so if you don't expect the breakout to occur fairly quickly, I do like the diagonal spread. I think the diagonal can be played today. I do not think the vertical should be played today.
Mm-hmm. With you, Mark. Anything you want to throw in there?
I just think with the vertical, you have a more aggressive directional bias than with the diagonal. Both have a directional bias, but I do believe the vertical has a slightly higher directional bias to it.
Mm-hmm.
And so because of that, I think you got to couple your technical analysis a little bit more on the vertical than you do on the diagonal, where you're treating the diagonal more as zone defense, lobbing grenades, and covered calls, right? You want to capture that time decay. You want the stabilization. And so I like both of them. If we're looking at making the trade today, I do lean the diagonal, absolutely. But again, breakout, and you want to be aggressive,
You might have a different answer tomorrow.
You might have a different answer, but I'm going to go with diagonal simply because of where we're at today. And we're showing a little bit of weakness at resistance. If we were breaking out and running, it would be the vertical. But for now, I like the vertical, but honestly, I could listen to Tyler geek out on options.